One of the most common objections you're going to hear when presenting your clients with the idea of investment real estate is, I don't have the money. While some people really don't, many have it, but it's tied up in things like brokerage accounts, IRAs, and former employers' 401ks. They likely also have a financial advisor who provides them investment guidance, such as the best way to make money is not timing the market, but time in the market. Advisors always stress to clients how important it is to weather the bad times and not sell, because if you miss the 5 or 10 or 20 best days in the market, the 11% long-term average return of the stock market gets reduced by each of the best days missed. So as much as clients want to sell during bad times, they keep getting reassured by their advisors to hold on or else risk hurting their financial futures. The truth is, it's nearly impossible to time the market perfectly to only be invested during good times and sell out during bad times, so to that degree the advisors are telling them the truth. But it's also true that the wealthiest people in the world did not get that way by just buying and holding mutual funds recommended by their stockbrokers. So there's some kind of disconnect there. Remember too that the clients that you help buy and sell homes to are the same clients who may also have an investment advisor. You share the same clients. Clients just come to you for different reasons. However, the message the advisor communicates gets reinforced year after year at their annual portfolio reviews, whereas your message gets forgotten after their buy or sell transaction is completed because you don't believe you have a reason to reach out to them each year. However, the dollars they could be using to buy more real estate is now being held in stocks, bonds, and mutual funds, because whether you realize it or not, you are competing for the same dollars with their advisors, and quite honestly, you're losing the messaging war. If only there were a way that you could capture some of that buy and hold stock market money to free up dollars for your clients to then buy investment real estate from you. As a former investment advisor, I can tell you exactly how in today's video, so stick around. Hey everyone, I'm Russ from the Neon Bros, where providing financial education to your clients can help fill your pipeline and earn you bigger and bigger commissions. That's the entire point of this channel. If today's topic sounds compelling to you, please like the video and subscribe so YouTube can share it with other real estate agents looking to sell more houses. Today, we're going to talk about how to, quote, pry some of these dollars that are locked away in a buy and hold strategy inside clients' brokerage accounts, IRAs, and old 401ks. I use the word pry in quotes because most investors' impulse is to sell whenever the account starts losing money. It takes a great deal of discipline and repetition by the investment advisor to calm their fears and explain over and over again that their best course of action is to stick to the plan. I raise this point because your ability to persuade them to sell off volatile investments is right there for the taking. If you provide them with solid reasons that they should not continue holding investments that are down in value, clients will very likely use those reasons on their brokers, who'll be left stammering like Ralph Cramden on The Honeymooners. Homina, homina, homina. Your next concern might be that you're harming your clients' financial futures by knocking them off their plan, and naturally, you don't want to do that. You want to help your clients, but you are helping your clients. You'd only be hurting them if you suggested they replace their stocks, bonds, or mutual funds with something that performed less well, with greater volatility, less income, and or fewer tax benefits. Does that sound like real estate to you? Not to me, it doesn't. Real estate has smoother performance, longer periods between downturns, shallower downturns, provides income, and automatically offers tax incentives. Real estate addresses many of the things that frighten them about stocks. Let me share my screen with you to show you what you're actually up against, so you'll see how easy a case this is to make to improve the lives of your clients and yourself. But before I do, if you need some help closing more sales, my service, Opportunities Everywhere, as explained by our lovely spokesmodel, my avatar, can help. Successful real estate agents know one thing: you're only as strong as your pipeline, but keeping it full shouldn't feel like a grind. Cold calls, awkward networking events, and endless mailers might get your name out there, but they drain your time, energy, and enthusiasm. That's why we built Opportunities Everywhere, a smarter, easier way to attract clients you actually enjoy working with. Instead of chasing leads, our system creates them for you. Using a library of short, engaging 10-minute videos, it quietly teaches everyday people how and why to invest in residential real estate. Then, when they're ready to act, they come straight to you. The best part? These aren't just one-time buyers. They're future investors you've shaped from the start, clients who understand your approach, trust your guidance, and keep coming back for their next purchase. If you're ready to fill your pipeline with the kind of clients you've always wanted, visit opportunitieseverywhere.com to learn how. All right. So, what we have here is the 100-year history of the Dow Jones. And as you can see, it looks like a kind of a not a straight line, but a roughly a 45-degree angle upward from the beginning to the end. And this is actually, you know, this is what entices people to invest. So starting in, this is actually more than 100 years. It's starting before the 20s. But from, I guess this is roughly what, 1915 to present day, you could see it's exactly what you'd want to see in a chart that you'd want to invest in. So this is why people do invest. They see it's, if you wait things out, you're going to make money. So that's kind of what the basic message is here. But now I'm going to show another the same chart to you, but with a little annotations on it, so I can explain some things that I want to point out to you. So this is the same chart I just showed you before, but I just have some things marked off on it. Let me see if I can point your attention. This over here is 1929. So this is the stock market crash that that everyone knows about. But what's interesting about this is that if you look at how the performance of the market goes, is it drops precipitously as you would expect it would, and then it starts coming back, which is great. This is what entices people to buy into the stock market. But if you look at how long this takes, I know this is very small, so you'll just have to take my word for it. I wrote here 1929, and I wrote here, it looks like 1954, and I might be off by a year or two, but it's basically 1929 to 1954. And what I'm looking for here is the point at which the stock market exceeded its peak in 1929 and never gave it back. Because if it just gave it back, I don't consider that making money. So it took until from 1929 to 1954, 25 years, before it actually hit a point where it matched the peak of 1929 and continued growing thereafter and didn't give it back. If you see here, I don't know if you can see my cursor, but I'll describe it anyway if you can't. In 1936, we have a mini peak here. So for anyone who was fooled by the recovery after the 1929 crash, and they got in roughly 1936, and got in, they immediately lost money as well, and they didn't recover till it's either 1949 or 1950, I believe. I write 1950 just to round it off. So that's a 14-year period. So 25 years that envelops the 14-year period. Then if we go into the 1960s, it looks like roughly 1964, 1965 hits a peak. This is where the note here, it's very small. It looks like it's the oil crisis that's affecting things. So oil crisis and stagflation. So from 1964 to 1982, it looks like nothing has basically gone on here. So, anyone who got in the market over here had to wait 18 years before they started making money again. So that's a long time to go thinking that you're investing. You think you're investing, but you're really just stuffing money in your mattress without knowing it. But you're taking on a lot of risk. The risk is that this could have gone down a lot. So then we get into the around the dot-com bubble. So this is 1999 to about 2011. So about a 12-year period where it just, it exceeded it here maybe in, I don't know what this is, 2007, I guess. It peaked and it did exceed 1999, but then it gave it right back. So I didn't mark that off. It really didn't match 1999 again and exceed it and not give it back until about 2011. So that's about 12 years before you actually started making money. So these are long periods of time to give up thinking that you're making money when you really aren't. So that's really what I wanted to point out to you here is that when people look at the stock market and they say, well, it averages 11%, that's fine. But there's a lot of periods of time where that's not the case. Here's a long period of time here, from 1929 to 54, a long period here in the 60s and 70s, and another 12 years here. So that's a lot of time to give up as part of your plan. If you happen to need the money anytime during these periods where it's flat, there's really nothing you can do about it. You have no control. And, I don't consider that an investment. When you're not making money year after year, it's just not a solid plan, in my opinion. There's other things that you can do. So as you can see, the general long-term trend of the Dow Jones Industrial Average is upward at roughly a 45-degree angle, as any investor would want to see any investment perform before they invested in it. However, that long-term pattern hides a multitude of sins in that it periodically goes decades, a couple of times even a generation, without generating any positive results. If you add it all up, not even counting the fact that one of the down periods from 1936 to 1950 was enveloped by the 1929 to 54 period, you have the 1929 to 1954 period of 25 years, the period between the mid 60s through the early 1980s, which was 18 years, and then the lost decade from 1999 to 2011 of about 12 years, which adds up to about 55 years. Since 1929 was only 96 years ago at the time of the recording of this video, that's 55 years out of 96 of the stock market just performing nothingness. That's almost 60% of the time it has not made any money for those in it. That means it has done all its work in the other 41 years. Can clients count on a financial plan like that? What if they retired in 1929? Think about how many people lived and died before they would have made their money back. What if someone saved up money for college for a newborn baby in the mid 1960s, and that child would have had nearly the exact same amount in her account when she needed it in the early 80s to go to college? Let your clients decide, of course, but a plan that fails more than it succeeds is a plan worth questioning. As we saw on the chart, so many times it appeared investors were making money only to give it back years later. In my experience, most clients just want an investment that grows each year at a reasonable rate without fear of giving it back when they think they've earned it. Many clients have expressed that if the stock market gives them a long-term average of 11% with a lot of aggravation, they would be happy to receive about 8% if it were smoother. My guess is they'd be very interested to learn about the opportunities for appreciation, positive cash flow, tax write-offs, and equity growth, all funded by a future tenant that real estate offers and that you can show them. In any given year, if one way to make money in real estate doesn't work, another likely will. It has built-in protections. So to all the investment advisors out there, game on. So what do you think about all this, about presenting your clients with this kind of information? Does this help compete better for more of your clients' dollars so you can sell multiple houses to them over a course of their lifetime? Please put your comments down below. Well, that's all for now. Until next time, I'm Russ from the Neon Bros, helping you and your clients to be successful in real estate.